So where we left off in the last video on Monday is we had created a model where we had forecasted out 10 years worth of financial statements, creating 10 years of economic statements, and therefore 10 years of forecasted cash flows. And so what we're going to focus on today is finishing up the valuation model by adding in 2 valuation tabs. We're going to value the cash flows using an economic profit model and a enterprise discounted cash flow valuation methodology. Right? So that's really what we're going to focus on today. Right? So conceptually, if we go back to lecture 4, when we talked about how McKinsey had valued Home Depot using the enterprise DCF methodology, there was a reference that said this is basically the process that we're going to use for enterprise DCF valuation in this class. So ultimately, we're going to put together a tab that looks a lot like this screenshot. This is a template that we're going to use for the enterprise DCF methodology. So going to our Excel model, what I'm going to recommend is that we do 2 things. First, one change from Monday is that when we had forecasted out change of equity, one of the things that we're not going to do is we're not going to forecast out directly share buybacks and share repurchases. So for starting in year 2013, for share issues, share repurchase, and minority interest, we want to make these 0. Actually, not 2012, 2013. We want to make these 0 and paste that out. Copy the 0, paste this out. Okay. So as I said, we're not going to make any changes to the share structure of the firm, so we're going to 0 it out. So one might ask, well, gee, how do we represent in our model share buybacks, share repurchases, and or dividend payments? And the answer is going to be in CFI with excess cash. So since we're going to hold the capital structure and the payments constant, that's why our CFI is constant in the out years. But what you'll notice is that the excess cash balance of the firm will continue, and it'll increase over time. It's probably easier to see on the balance sheet, will become a larger and larger number. And so, as I said, if you remember conceptually, what we talked about is that excess cash represents the cash that can be paid out. So really, it's the future excess cash balance that represents the payouts of increased dividends or stock buybacks. So rather than trying to guesstimate it granularly, we're just going to say, here's how much cash that can be distributed, and it will be accounted for in our valuation model. Right? So that's why, as I said, in the change in equity tab, we're not going to try and forecast out in the future stock buybacks or payments to minorities. We're just going to use the excess cash as a proxy for what that amount can be in the future. Right, so I wanted to establish that as we start building out our DCF valuation model. So once we've done that, we're going to go to the last tab of the model. We're going to add a new sheet or a new tab, and we're going to call this DCF, for the Enterprise Discounted Cash Flow Valuation. And I'm going to change my zoom here to 200%. Just make it a little bit easier to see. Okay, so we're going to follow the 4-box method for valuation, right? So again, operating plus non-operating cash flows equal enterprise value. We're going to start out with valuing the operating cash flows of the firm. The operating cash flows are based on the free cash flows. So when we do our valuation, we need to know what the free cash flows are. Now, I'm going to list the free cash flows down the rows rather than across the columns, because when we print out this sheet, we want it to print it out on one sheet of paper. Okay, so in order to get it to fit, I'm going to do it in portrait versus landscape, which we had done the other pages. So our first year, we want to make a relative year in our forecast. As we'd forecasted the free cash flow, our first year forecast for the free cash flow equals, from CFI, would have been 2013. And again, I want to make this a relative reference so that when I reuse the model and or change the years, everything goes accordingly and gets updated. So what I don't want to do is I don't want to hard code the years. Okay. So again, what we forecasted out, and I'll go back to our lecture notes here, is we're forecasting, this was in last week's reading, sort of a 2 periods of time. We're forecasting out a defined valuation period, which we've arbitrarily said is 10 years, and then we're forecasting out a continuing value period, which was year t plus 1, or in this case, year 11, or 2023. Okay? So that's what we're going to represent in our valuation model. So essentially, the first 10 years are the defined period. So I want this to be year plus 1 going out to 2022. Okay? So that is the first 10 years where we have explicitly forecasted free cash flow year by year. Right? So the forecast of free cash flows are coming from the CFI, because when we forecast the income statements in the balance sheet, it created the forecast for the free cash flow in the CFI. So our forecast right now in the model for 2013 free cash flow off the CFI, which is row 12, 2013, so H12. 2014 free cash flow is currently forecasted as I12. 2015 off the CFI, J12. 2016 forecast for free cash flow off the CFI is K12. 2017 forecast for free cash flow is L12. 2018 forecast for free cash flow is M12. 2019 N. 2020 is O. 2021 P. And 2022 is Q. So H, I, J, K, L, M, N, O, P, Q. All right, so those were, assuming that our ratios and assumptions come true, those were our forecasts for the free cash flows. So essentially, this is what we assume that Coca-Cola will generate in cash flow selling its products over the next decade. What we have to do is we have to present value these free cash flows. Okay? So I'm going to use the concept of a discount factor, which is 1 divided by 1 plus r to the n or the t power, to put it into present value. So in this case, 1 divided by left paren 1 plus the discount rate, and off the assumptions tab, the discount rate we're going to use is the weighted average cost of capital. So, and when I go back to the assumptions tab, change the zoom to 200% to make it a little bit simpler, but we're using a 6.5% discount rate. Well, using a 6.5% discount rate is the same as multiplying by 0.93896714, right? 1 divided by 1 plus r to the n. Okay. Now, I'm about to copy this down, so what I'm going to do, because I'm going to use the same cost of capital, is put a dollar sign in front of a B and a dollar sign in front of the 4 to make that an absolute reference. Okay. So my discounted free cash flows are the free cash flows times the discount factors. So 8042 is worth approximately 7552 in present value. Okay. I'm going to do this for 10 years. Now the difference is I divide by 1 or multiply by 1 divided by 1 plus r to the t or to the n. So in the second year, I have to square the discount rate, so to the power of 2. In the third year, to the power of 3. Fourth year, power of 4. Fifth year, power of 5. Sixth year, power of 6. Seventh year, power of 7. Eighth year to the 8th power. Ninth year to the 9th power. And 10th year to the 10th power. So again, let's make sure 2, 3, 4, 5, 6, 7, 8, 9, and 10. Okay, so those are my discounted free cash flows for the next decade. So what I then want to do is I want to sum these. So my operating value for 10 years is going to be the sum of those discounted free cash flows. So what we're going to say is that the value of Coke in its sales of its products, soda, water, etc., over the next decade in present value terms is going to be $65.7 billion of present value of free cash flow running their business for the next decade. That's the operating value of Coke for the next decade. What we then want to do is say Coke is going to continue its operations past year 10, year 11. It's the beginning of our continuing value period. So I want to value Coke from 11 into perpetuity, right? Now, to do that, we are going to use, for the continuing value, the key value driver equation. So our key value driver formula that we previously defined this semester is represented here on this slide. So it's the NOPLAT times 1 minus the growth over the ROIC divided by the WACC minus the G. Okay? So those are the key value drivers that will drive the continuing value. Notice that it's the NOPLAT and T plus 1. T plus 1 is the first year of the continuing value period. That's why we built the model on the first part of the model. We said we're going to forecast 11 years. We're always going to forecast an extra year. 10 for defined, extra year, the T plus 1 year, is the start of the continuing value period. In this case, that's 2023. So I'm going to need my 2023 NOPLAT, my 2023 ROIC is my RONIC for 2023 going forward. I'm going to need my long-term G, and I'm going to need my WACC. So what I'm going to do is I'm going to need to put in a formula for continuing value for the firm in free cash flow. Now, those are the assumptions that I need, so what I'm going to do is I'm going to put them in the assumptions tab. All right, so again, I want to aggregate the assumptions in as few places as possible, so I'm going to put the assumptions for the key value drivers in the assumptions tab. So the first assumption I'm going to need is the continuing value NOPLAT. Then I'm going to need my continuing value ROIC, also known as RONIC. And I'm finally going to need my continuing value G. I'm going to make all these yellow because these are assumptions that I might choose to change in the future. So my continuing value NOPLAT is my 2023 NOPLAT, which in this case is off the TII. And we had forecasted a NOPLAT in 2023 of 11,822. My continuing value ROIC is off my beginning of year economic profit tab, not the end of year. Make sure you use the beginning of year because that's how the valuations will balance. And I always use my ROIC including goodwill. So row 15, ROIC for 2023 is about 30.6%. Format cells percent. Make that one decimal place. And my continuing value G is going to be 3% as a starting assumption. So remember, G is the long-term growth in cash flow. Think, how much is my cash flow going to grow in year 10, year 20, year 30? And so what we're going to use for G is 3%. And the reason we're going to use 3% as a starting G is we're going to say that long-term companies will generally grow at about the rate of the economy, particularly for a consumer products company like Coke. Generally, U.S. and European economies, which are mature, have been growing at about 3% a year over a longer period of time. So we're going to use 3% as our starting assumption for G. If we believe a company should grow faster or slower than economies long term, we can ultimately adjust it. But remember, G cannot be higher than your cost of capital, nature of the perpetuity equation, and generally is not negative in most cases. So usually between 0 and 6% for most companies, but obviously we can make specific adjustments later. But we're going to start out with a 3% for Coca-Cola going forward. Yes?
Real quick, can you show where you got the ROIC from again?
So the 30.6% is coming from the EPBOY tab, R15, which is the ROIC forecast for 2023. we're saying that right now is representative of the long-term continuing value ROIC, also known as the RONIC. All right, so those are my 4 assumptions, and these are the assumptions for this equation. So now what I need to do is put this equation in our model. So back to the DCF valuation for the continuing value equals left paren. What that formula says is we take our no plat, we multiply it by left paren 1 minus the growth divided by the ROIC, right paren, and we then divide that by left paren, the WACC minus the growth, right paren. So assuming I have the correct order of operations, I should come up with a continuing value of 304,705 and change. Show the formula?
Yes.
So basically, that's the formula, which is basically this formula. Okay, assuming you have the same rows that I do as you're building this. Okay, so assuming that you typed it in correctly, then you should get 304,705.53, whatever it was. Okay. All right, so what we're saying is that's the value of Coke into perpetuity from year 11 forward based on its operating value. But we want to present value this for our valuation. Now, embedded in the perpetuity equation is a discounting. So that means this is the discounted value as of the beginning of 2023. All right? And what we want to do is bring this back to the present. Well, January 1st, 2023 is the same as December 31st, 2022. So what I really need to bring this back is 10 more years to the present. 2023 has already been discounted. I don't want to make a common finance error where I double discount that year. So therefore, I use the same discount factor as I do in 2022. Right? When I do that, equals this times this, or about 162 billion, and I'll add an extra row here just so it's easier to see, 162 billion of present value of the continuing value. So basically, in the first decade, Coke is going to generate operational value of about 65.7 billion. In the second decade, about 162.3 billion. So that the overall operating value of Coke is going to be the sum of those two, or approximately 228 billion, 55 million. Right? That's the value of Coke given the assumptions that we've currently made on the ratios tab. That's the operating value selling its products and services. Right? So remember, if you go back to our valuation methodology, we're going to take the operating value and then we're going to add into that the non-operating values. Okay? So now we need the non-operating value of Coke. Well, the nice thing about that is we've identified the non-operating assets on our TFI when we rearranged it. So if I go to my TFI, we can see that we already listed 3 non-operating values: excess cash, non-operating assets, net of non-operating liabilities, and long-term investments. So those are the 3 non-operating assets that we have to value. Okay. Now, the beauty of the balance sheet is we're going to use the 2012 values for each of those numbers because those are the last reported results and they're already in present value, so I don't have to discount them. So I'm going to take the 2012, or the current excess cash, off of TFI, 2012 excess cash, the 2012 long-term assets, and the 2012 long-term investments. Right? And as I said, because it's the 2012 or current values, I don't have to discount them. They're already in present value format. Right? So remember that enterprise value is the operating and the non-operating values. So what we're saying is that the enterprise value is the operating plus the non-operating values, or 265,624.31. All right? So that's our forecast for the enterprise value of Coke, given the current assumptions. Now there is one other assumption that I am going to add, which is, I'm going to do this in row 9. I'm going to call this the price to book multiple of long-term investments, aka the equity investments. I'm going to make this yellow, and I'm going to make this initially 1 as a value. What I'm then going to do is I'm going to come back to my valuation. I'm going to take the long-term investments, and I'm going to multiply it by that price to book multiple in the assumptions tab. Right? Reason I'm doing this is that we're trying to do a market-based valuation of a company. If a company makes an equity investment or a long-term investment in another company, on its balance sheet, the accountants record that at book value. The market value could be far different. So for example, about 6 or 7 years ago, Microsoft made a $1 billion investment into Facebook, right? Well before Facebook went public. And they owned about 1/15 of Facebook as a result of that early investment, right? So on Microsoft's balance sheet, they list the $1 billion investment in Facebook. But now that Facebook is public and years later is far more valuable, that value has grown, right? But if I just look at the book value, it's not represented on the balance sheet. So I want to figure out a guesstimate of what that market value is, and then I can use the price to book multiple to adjust that. So for example, let's assume that they're trading at 7 times what they originally invested based on open market prices. This is just a random assumption. I don't know if it's true. But what I could do is I could change the price to book multiple to 7. And then in our valuation, it would adjust the long-term investment value by a multiple of 7. Okay? So in an ideal world, we want to know the real value of a company's long-term investments and adjust it to a current market value. However, if we have no idea what that value is, and right now for Coca-Cola we do not, what we also could do is we could assume that the book value is kind of a floor. Because what accountants do is they don't write up the value of appreciating assets, but they do write down the value if the value of the original investment goes down. All right, so I generally know that it's probably not worth a lot less than this. It could be worth more. So if I want to at least be conservative, I'll use the book value of the long-term investments. But if I really think a company has some long-term investments that have grown dramatically, ideally I want to try and figure out what those values are and adjust them to a current market value. And that's what that multiple is doing. But as we're just setting up our base model, I'm going to add these up, and that gets my enterprise value. Right? Saw a hand for questions? Questions about what we've just done? All right, so continuing. This is the enterprise value. 1 plus 2 equals enterprise value. And that's the cash that I'm forecasting that I can distribute to the debt and the equity holders, the 3s and the 4s. So essentially, common shareholders get what's left after everybody else has been paid. So what I want to do is I want to subtract all the other people I owe money to, all the other 3s and all the non-common 4s, to figure out what's left for the common shareholders. So again, this is where the TFI statement can be helpful. So on the TFI, I can see that I have 2 debts, retirement-related liabilities and interest-bearing debt. So I pay off the retirement-related liabilities, and then I pay off the interest-bearing debt. Then I pay off the preferred stock and the minority interest. Notice I don't pay off the common shareholders because I'm trying to solve for what the common shareholder value is. That would be double counting, right? So basically I pay off the non-common claimants of those enterprise value of the cash flows. All of the debt equivalents and all of the non-common equity equivalents. Those are the 4 that are on the balance sheet. I'm also going to use the 2012 values or the current values for the company because they're already in present value and that's what exists today. So in this case, the 2012 retirement-related liabilities and the 2012 interest-bearing debt. And I want the 2012 preferred stock, if the company has any, and the 2012 minority interest. So that my common equity value equals the enterprise value minus the sum of these 4 items. or 229,324. Right? So that's my guesstimate of what the value of the shareholders' cash flows will be in present value once everybody else has been paid off. Right? Final assumption, how many shares outstanding does Coca-Cola have? Oh, standing. Right? Now, I'm going to actually put this on the assumptions page. Make this yellow because I don't want to have just miscellaneous assumptions strewn throughout my model. I'll forget that there's a cell that I need to change. That's why we're using the assumptions tab so that everything we change is in a limited amount of places so it's easy for us to reuse the model. So in this case, I need to look up the shares outstanding. In Bloomberg, that is going to be the DES screenshot is the easiest place to find it. All right, DES stands for description, and on the bottom left-hand corner, it has the current shares outstanding for a company. In this case, for Coke, 4456.7. So I'm going to go back to my DCF valuation tab, reference that amount of shares outstanding off of the assumptions tab, and then I am going to calculate a forecasted share price equals the equity value divided by shares outstanding, or $51.46. So what we basically said is if the ratios for Coke that they achieved in 2012 repeat themselves into the future, they're worth about $51.46 a share on a cash flow basis. By the way, on Monday, Coke stock started the day with a share price of $40.44. So even as we're getting started here with some simplified assumptions, we're not that far off from their actual share price this week. Right? So we can actually think about this in terms of what the market is telling us. Right? What the market has basically said is Coke is worth 40, we're coming up with a value a little over 51. So what the market says is that the assumptions that we're using are probably a little bit aggressive versus what the market's currently using in terms of its share price. Right? I don't want you to do what I'm about to do, for those of you watching the video and following along in the class here. But this is what we're going to go with this on Monday. Right? So on Monday, what I could do is we're going to do what's called an as-is valuation of a company. So we're going to go to the ratio screen, and what we're going to try and do is a what if on the ratios to say, what must the market be thinking to get the current share price? Right? And when I say what the market is thinking, what I'm saying is that the institutional investors determine Coke share price. Right? It's basically the top 20 to 25 institutions probably own 50 to 70% of most companies. They're the ones that determine the share price of the big companies. So the institutional investors have hired MBAs from top business schools, and they all know these DCF methodologies. And they're applying their own DCFs. So what we're really trying to do is kind of back into what assumptions must they have been using to price the companies as they're priced today. So for example, as a what if, I can say, what if growth, instead of being 3% a year, was 0? Well, at a 0% growth rate, that actually works to a $39 share price, which is very close to the current share price. So one possibility in our next dialogue could be, you know what? Maybe the market doesn't think that Coke has growth opportunities in the future. And it's not that more people aren't consuming Coke in emerging markets, but the problem is sugar, very much like nicotine, is becoming perceived very negatively. And Coke is a company that sells sugar water. So basically, as people move towards healthier drinks, it's bad for Coke in the long term. So maybe that's the fear that's already starting to creep into Coke stock, that are they really going to get that growth? Could be something else, but that's what I'm saying. Eventually, we're going to get into this kind of what-if analysis to model out what we think are fair values of the company. And very quickly, as we change the assumptions, we can see what that impact to share price is. I don't want you to do that now. We're still building out our model, but that's what we're eventually going to do with our model. So I'm going to undo that change. You're going to ask a question? Okay. All right. Any other questions at this point? Yes?
Can you scroll over your tax rate? Yeah, and that's fine. I'll find it.
For tax rate?
Yeah.
So for 2013, we're using an average tax rate of the last 6 years. For 2014 and beyond equals the previous year. And then we copied the equal previous year going forward, right? So as I said, eventually we want a representative tax rate. Maybe we might one day determine, you know what, the average of the last 6 years isn't representative and we actually think it might be higher on a go-forward basis. We could change that, right? But for now, we're just using the average of the 6 years as a starting point, and then everything else just equals the previous year. That was just one of the assumptions we made when we started building the model. Other questions? All right, so we've now completed the DCF valuation tab for Coke. Now we're going to do the second valuation methodology, the economic profit valuation methodology. So again, if we go back to lecture 4, when McKinsey did their example of the Home Depot valuation, they also talked about using an economic profit methodology, how they would value Home Depot using that methodology. What's primarily different about the two is how the operating value is calculated, right? So it's a different set of formulas for the operating value. Everything else is the same, and we get the same answer. Because remember, just because we're changing our assumptions on how we value a company doesn't change the actual value of the company itself. So if we rearrange the equations, we still got to come up with the same value for the company. And that's all these other valuation models are. They're just rearranged equations, so we have to get to the same result. So we're going to basically do the economic profit valuation methodology and come up with the same answer as our DCF. All right? Matter of fact, that's going to be the final exam. The final exam, I'm going to give you a series of cash flows. You're going to have to value them using both methods and come up with the same answer. If you can do that, you're going to do well in the final exam. If you can't do that, well, not so well. All right? So let's go back to the Excel model here. Because most of what we're going to do is a repeat on this EP valuation, I'm going to clone the tab. So the way you clone a tab in Excel, or a worksheet, whatever you want to call this, is you right-click on the sheet, move or copy, select Create a Copy. I'm going to put it at the end, hit OK. And that's going to make an exact copy of our DCF tab, called DCF Valuation 2. And I'm going to rename this to be EP for Economic Profit Valuation. So as we build the economic profit valuation, I'm going to start out with a clone of the DCF tab. Now, what's primarily different about the economic profit methodology is economic profit is about the change in value as opposed to the absolute cash flows that a company earns. So rather than forecasting free cash flows, we're going to forecast economic profits or forecast change in values. So I got to wipe out these free cash flows, clear the contents, because these are going to be the forecasted economic profits. I'm still going to discount them at the same cost of capital, and instead of the discounted free cash flows, I'm going to have discounted economic profits. Right? So I'm going to basically look at the change in value for the first 10 years, the defined period of the forecast, and those are my specific economic profits. So for 2013 equals from the beginning of year economic profit tab. It's very important to use the EP BOY tab because the only way that the DCF and the EP valuations match if we use beginning of year economic profit and invested capital and ROIC. So off the BOY tab, the 2013 economic profit after goodwill, so it always includes goodwill for valuation, 2013 is H23. 2014 off the EP BOY tab is I23. 2015 is J23. 2016 is K23. 2017 off the EP BOY tab is L23. 2018 is M. 2019 is N. 2020 is O. 2021 is P. And 2022 is Q. So just make sure Valuation-Model-Part2. Same discount factors. These are the discount economic profits. This is the operating value for 10 years of the economic profit. So that's basically the change in value of Coke over the first decade, 54, 760, 07. Right? Now, when we do the economic profit methodology, again, if I go back to our lecture note, what we're doing is we're looking at the change in value. Go back here. When we do the enterprise value, we're looking at the total cash flows of the business. When we do the economic profit, we're looking at the change in value of what was invested. Right? So what we're going to do is we're going to take our starting invested capital, or beginning invested capital, which is how much money we've started with in the business. In this case, it's our 2012 invested capital. So if I go back to my TFI, I started with invested capital of 31,521. In the first 10 years, I've added $54.7 billion worth of value. In the continuing value period, there's a different formula for continuing value of economic profit. So I'm going to wipe that formula out and replace it. But basically, how much value I add in the continuing value period, I sum those three up, and that becomes the operating value of the firm. Right? And basically, the operating value of the firm, using the economic profit methodology, has to match the operating value of the firm using the DCF valuation methodology. So basically, the number that I'm shooting for is, in the DCF, we came up with this operating value. In the EP, we have this current operating value. So if I subtract it, basically I'm off by 141,774. So I need for this number to be 141,774. I just took the operating value off the DCF tab and just subtracted the operating value off the EP tab, because eventually the difference between the two needs to be zero. Right? So when I put in my continuing value for economic profit, it's going to have to come up with essentially that number so that this difference between the two valuations is zero. They have to be exact. Right? Now, I and the TAs are smart enough to know that you could just plug that number right in here and get your spreadsheet to balance. That is not a correct answer, either here in the model or on your final exam. You must calculate it independently and come up with the same valuation. Right? So, we need a continuing value of economic profit. Yes?
Did you get the start IC from?
The which one?
The start IC.
The starting invested capital. So if it helps, I can write it out as invested capital. Is the 2012 invested capital. So on the TFI, it's the 2012 invested capital. So that's what we started with based on the last reported year. So Coke has invested $31 billion and change. How much value did they add to get to their current share price? That's really what EP, or EVA as it sometimes called, represents. In the first 10 years, we added that much value. In the continuing value period, that's what we're trying to understand. So the formula out of the book for continuing value of cash flows is the key value driver formula. Because we're not doing cash flows, we're doing economic profit, we have to rearrange it for economic profit. The rearranged key value driver formula for economic profit is this formula. This very big, complicated, ugly formula. So what we have to do is we have to put that formula into the continuing value cell with the correct order of operations, which is probably the hardest thing you got to do as part of the model. So the one new variable that we need that we didn't have before was economic profit. Everything else was part of the key value driver formula. So what I'm going to do is I'm going to go back to my assumptions tab, and I've left row 8 blank for a reason. I want my continuing value of economic profit. That is my 2023, or year 11, T plus 1, EPBOY. So 2023 economic profit, row 23, R23, off the BOY tab. So that's my continuing value of economic profit in the year 2023. So those are the 5 items that I need as part of my continuing value formula. So what I'm going to do is I'm going to go back to my EP valuation and start creating that formula. So equals, left paren, working off of the assumptions tab. Economic profit divided by WACC. So continuing value EP divided by WACC, right paren. And I'm going to add to that left paren. No plat times left paren growth divided by ROIC right paren times left paren ROIC minus WACC right paren divided by left paren WACC times left paren WACC minus G right paren. Sometimes it takes me 2 or 3 times to get this formula right with the correct order of operations. So I'm just going to cross my fingers here and hopefully I got it right on the first try. Hit enter. Difference of 0 operating values match.
Just show the formula again.
Sure. Before I show the formula again, though, I want to show you something. When I say difference of 0, format cells, number, decimal places, 10. 0. No difference. Not off by $1, not off by 0.01, exact. That's the point. If you use the beginning of your invested capital, beginning of your ROIC, then you will get an exact match between the DCF and the EP valuations, right? So to have a correct answer, you got to be exact, right? That's why I'm going to encourage you to use Excel, not calculators. If you use calculators, you round to 3 or 4 decimal places, you'll be close. If you use Excel, you will literally be exact between the 2 valuations, right? This is key to your models and to your final exam of this class. You got to do both methods, show that they're exact, right? So, formula you asked about for correct order of operations is here. So again, for those of you watching the video, you're welcome to pause it, copy the formula, but that's the formula that you need in your model, right? So what the formula basically said is, here's the change in value in the continuing value period through 2022. We present value that back to today, add that to the value of the first 10 years change in value, add that to the beginning invested capital, sum those 3 up, and we get the overall operating value of the firm. Same non-operating value, same debt, same non-equity cash flows that have to be paid off, same share price. All right, so again, what's really different about the 2 methodologies is how we calculate the economic profit. Right? Questions? Yes?
Is that supposed to be a percentage?
No, it's a dollar amount. I had it, for some reason it was showing up as a percentage, so I had to switch it to formatting to dollars. Right? Other questions? All right, so I'm going to wipe out this operating value difference because now that we have it balancing, we don't really need it in there. But notice we get the same share price. All right, so what I then want to do is I want to go back to the ratios tab. And I'm going to put in forecasted share price. And then I'm going to refer to the DCF valuation share price as a reference so that when we finish the valuation of a company, we start changing the ratios, we don't have to keep jumping back and forth between tabs. We can actually see, as we change the assumptions, how it affects the share price. Okay? So this completes the valuation model. This completes your assignment for homework 6. At this point, if you have everything that we've done, all the tabs, you have 2 matching valuations tabs that go to 5146, then you can submit homework 6 and get full credit. Right? So basically, this is where we're going to end the model building for today. Right? Now, what I'm about to do is what we're going to cover in the next class. So you don't have to do this for homework 6, but this is where we're going. Right? So as I said, we can quickly do what ifs. We can quickly do a what if that says, what if the margin of Coke fell because its cost went to 39% as a percentage of sales? And I can quickly see what the impact of the share price is. Or, what if Coke, undo that, what if Coke had to spend more on net fixed assets? What would be the impact of the share price? Right? So again, as we change the assumptions, it will ultimately change the valuation. So what we've created, we're going to refer to the spreadsheet in its current format, and I'm going to start calling this the baseline valuation. It doesn't have any meaning outside of this class, right? It's just a term that I'm coining that basically says we've taken the company's financial data and assumptions and put it in the model, and we're now ready to start the valuation. I'm just going to call that the baseline. Right, so that's going to be the first step. It's just making sure that we put the data in the model so we're ready to start the valuation. When you actually do your valuations, you're going to do 2 valuations. Right? The first is going to be called an as-is valuation. So if Coke's current stock price is $40.44, what we're going to next do is we're going to change these assumptions to get the share price very close to $40.44. That's called an as-is valuation. Right? So what we're doing is we're kind of backing into the current share price of a company, and we're trying to understand what are the assumptions that got us there. It's not whether we agree with those assumptions. It's we're trying to understand the kind of wisdom of the market. What assumptions on a cash flow basis must the market have made in order to justify the current share price? Right? So that's going to be the first valuation that we're going to do and that you're going to do as part of your group projects. The second valuation, we're going to call the final valuation. What we're going to then do is we're going to go back to those assumptions and we're going to say, you know what, let's put in assumptions that we believe to be more realistic. And that's going to come up with a second share price. The difference between the current share price and that final share price creates the buy, sell, hold. So if in our final recommendation, we are within 10% of the current share price, it's a hold, plus or minus 10%, trading range of a stock. If we're more than 10% above the current share price, it's a buy. And if we're 10% below the current share price, it's a sell. And so that's what you're going to do for your group projects. You're going to do both valuations. You're going to put in assumptions to value the company as is. And then you're going to explain in the PowerPoint and in the paper how you came up with those assumptions. What you're then going to do is you're going to change those assumptions. And then you're going to explain why you're changing those assumptions, fact-based, to come up with a final share price, creates the buy, sell, hold. Right? That's really most of what's going to be involved in the fourth part of your group projects for the valuation. Right? As I said, we're not doing that now. That's what our next class is going to be about. It's how do we take this and then come up with those 2 valuations for Coca-Cola. Right? And then after that, we'll practice using different companies. But as I said, if you've come up with and replicated what we've done here, then you have completed homework 6. And then you should just upload it and get the credit.